Hi everyone, let me be brutally honest with you. SCHD has been struggling lately. While the S&P 500 is crushing it, SCHD has been underperforming significantly. That's not what you signed up for. But here's what nobody's telling you. This might be the exact moment to build the smartest dividend portfolio of your life. I'm about to show you why combining SCHD with SPYD and SPLG creates a portfolio that works whether SCHD bounces back or continues struggling. No sugarcoating, no hype, just the raw truth about what's working right now. The institutional money knows something retail investors are missing. Let me show you what it is. Here's what the data actually shows. SCHD is underperforming badly. The numbers don't lie. Recent performance? SCHD has significantly lagged the S&P 500 during growth-driven periods. Growth stock gap. SCHD trails broader market indexes when tech leads. The problem? Heavy energy exposure. Approximately 19% weighs it down when tech is running the market. I see the comments. I see SCHD holders panicking. Some are selling, others are in denial. But here's the thing that changes everything. SCHD's struggles reveal exactly why you need all three of these ETFs, not just one. Let me break down the cold hard truth about each fund and what you're really getting. Problem number one, SCHD alone leaves you massively exposed. The brutal reality. SCHD has 103 holdings, but its top 10 make up over 40% of the fund. You're concentrated in old economy stocks like energy and industrials, while the world is running on AI and technology. Here's what's actually happening. AbbVie, ConocoPhillips, Chevron dominate your holdings. Zero exposure to Nvidia, minimal tech representation. When value underperforms, you get crushed. The three-part solution that actually works. Solution A, the reality check. SCHD at 40% maximum, not 100%. You need growth exposure whether you like it or not. Solution B, add SPLG for what SCHD lacks, 25 to 35%. Allocation to capture the tech and mega cap growth. SCHD completely misses. SPLG's strong performance would have saved your portfolio. Solution C, accept dividend diversification. SCHD's 3.9% yield is solid, but if you need income now, you can't wait for dividend growth. That's where SPYD comes in. Problem number two, high yield versus dividend growth. You're choosing wrong. Here's the uncomfortable truth. Everyone debates SCHD versus SPYD like you have to pick one. You don't. In fact, you shouldn't. The data reveals something shocking. SPYD, 4.6% yield, gives you income today. SCHD, 3.9% yield, gives you income growth over time. Both have faced market challenges in recent periods. Three strategies based on cold reality. Strategy A, the income truth. If you're retired or you need income now, SPYD at 30 to 40% isn't optional. It's necessary. SCHD's dividend growth means nothing if you can't pay bills today. Strategy B, the growth reality. If you're building wealth, SCHD at 35 to 40% with SPLG at 35 to 40% captures both dividend quality and market growth. Stop pretending SCHD alone is enough. Strategy C, the balanced approach. 30% SPYD income now, plus 35% SCHD income growth, plus 35% SPLG capital appreciation, a portfolio that works in any market environment. Problem number three, you're ignoring what the S&P 500 is actually doing. The painful truth. While you're holding SCHD hoping for a comeback, the S&P 500 often makes new highs during growth-driven markets. SPLG typically outperforms SCHD significantly during these periods. That's a massive difference. What institutional investors figured out. SPLG tracks 507 S&P 500 companies at 0.02% expense ratio. Top holdings, Nvidia approximately 8%, Microsoft approximately 6.8%, Apple approximately 6.6%. These companies are driving market returns while SCHD's energy stocks drag. Three allocation realities you need to face. For ages 20 to 40, building wealth. 35% SPLG, capture the growth that's already happening. 35% SCHD, quality dividends but not your whole portfolio. 30% SPYD, yield diversification. Reality check, if you're young and 100% SCHD, you're leaving money on the table. For ages 40 to 60, balanced approach. 35% SCHD, dividend quality matters more now. 35% SPLG, still need growth exposure. 30% SPYD, income is becoming important. Reality check, this spread protects you when any single strategy fails. For ages 60 plus, income focus, 40% SCHD, dividend growth you can count on, 35% SPYD, maximum current income at 4.6%, 25% SPLG, you still need some growth. Reality check, even in retirement, 100% dividend stocks is dangerous. The data that tells the real story. Let me hit you with the numbers that matter. Statistic number 1, SCHD pulled in over $11 billion in flows over 12 months. Institutions are buying the dip while retail panics. Statistic number 2, SPLG remains one of the most popular low-cost S&P 500 ETFs. Smart money knows you need broad market exposure. Statistic number 3, SPYD at 0.07%, SCHD at 0.06%, SPLG at 0.02%. That is equal to 0.05% average expense ratio. Compare that to 1% plus mutual funds. Statistic number 4, the 3-fund combo gives you diversified exposure across all sectors through hundreds of different companies. You're actually diversified, not just dividend-focused. Statistic number 5, SCHD's approximately 8 to 10% average annual return over 3 years proves it works long-term, even when it struggles short-term. Statistic number 6, SPLG typically outperforms SCHD during growth-driven market periods, showing exactly why you need both. Statistic number 7, SPYD's 4.6% yield versus SCHD's 3.9% is equal to 0.7% more annual income on every dollar invested in SPYD. Statistic number 8, all 3 funds pay quarterly, stagger them right, and you get dividend income nearly every month. The allocation reality for current market conditions. Here's what actually works based on current market conditions. The honest, aggressive portfolio, maximum growth. 40% SPLG, face it, you need the S&P 500. 35% SCHD, quality dividends, reasonable allocation. 25% SPYD, yield diversification. Expected reality, 3% yield with growth potential. The honest, balanced portfolio, real diversification. 35% SCHD, solid core, not everything. 35% SPLG, growth you can't ignore. 30% SPYD, income when you need it. Expected reality, 3.3% yield with market exposure. The honest income portfolio, maximum yield. 40% SPYD, you need income now, not later. 40% SCHD, dividend growth matters. 20% SPLG, some growth is still necessary. Expected reality, 4% yield with growth protection. Your step-by-step reality-based plan. Week 1, face the truth. Calculate your current SCHD allocation honestly. If it's over 60% of your portfolio, you're overexposed. Decide if you need income now, SPYD, or growth, SPLG, more. Set up your brokerage for all 3 funds. Month 1, build the real portfolio. Don't sell SCHD in a panic. That's the worst move. Add SPLG for the growth exposure you're missing. Add SPYD if you need higher current income. Use new money to rebalance, not selling existing positions. Month number 3, honest assessment. Review what's actually performing. Rebalance only if something drifts 10% plus from target. Increase contributions to whichever fund is lagging. Except that some periods SCHD wins, some periods it doesn't. The uncomfortable prediction. Here's what I believe will happen. SCHD will eventually bounce back. Dividend growth stocks always do over decades, but if you're sitting 100% in SCHD right now, you're going to suffer through extended periods of underperformance while the market passes you by. The 3-fund reality. SCHD for quality and dividend growth, but not as 100% of your portfolio. SPYD for yield when you actually need income. SPLG for the growth that's happening whether dividend investors like it or not. Institutional investors already cracked this code. They're not choosing between these funds. They're combining them strategically. The money flowing into SCHD isn't replacing S&P 500 exposure. It's adding to it. Here's the truth you need to hear. SCHD is a fantastic fund. Long term, it's one of the best dividend growth ETFs ever created. But right now, holding only SCHD means accepting significant limitations. You don't abandon SCHD. You build around it with SPYD for income and SPLG for growth. That's not giving up on dividend investing. That's being smart about it. Start with whatever you can afford. $500 split 3 ways, $1,000 allocated properly, $100 a month invested consistently. But stop pretending that one fund, no matter how good, can do everything. The market doesn't care about your feelings. It doesn't care that you love SCHD. It only cares about results. And the results say you need all three. This is educational content only, not financial advice. Consult a financial advisor before making investment decisions. Past performance doesn't guarantee future results. Love SCHD all you want, just be smart enough to pair it with what's missing. SPYD plus SCHD plus SPLG. The reality-based dividend strategy for investors who want the truth, not hopium. Please like, share, and subscribe. Here's to your investing success and profitable investing.